Hey guys, Ben from Pivot, and today I'm bringing you a bit of a new initiative that I've been working on around unpacking what's going on in the news in words that human beings understand and what it actually means for you as an investor and you for your money. So I've got a few articles that I've been reading, pretty interesting stuff, and just wanted to unpack what it means and what you should be thinking about. So the first one is actually two articles that I was looking at on interest rate rises and falling house prices in Sydney and Melbourne. And essentially, the RBA have come out and predicted a 15% decline in property market, in property values over the next 2 years as interest rates increase. We're seeing that the Sydney and Melbourne property markets are already declining. The problem here is that I suppose, firstly, noting that not all properties, not all suburbs and not all properties are expected to be impacting equally, with good properties in good suburbs holding their values and in some cases even increasing despite what's going on in a softer market. But for Sydney and Melbourne property owners and the rest of the country shortly to follow suit, the value of their equity in property values is decreasing, which potentially restricts options around investing. And that's really the key here. The opportunity, though, on the flip side of this is that for property owners right now, there's the ability to lock in equity values while the property prices are higher and then use that money to invest and actually grow your wealth and do it sooner. Look, the right moves here really depend on where you're at now, what's coming up for you, and what you're trying to actually achieve with your money. But to take smart action here, what you want to be doing is understanding your equity position and your borrowing capacity, really important today, and what money you can allocate to your asset building. Now, with the equity position in particular, you need to understand that that is a moving target. So if you're thinking about or feel that you're in a position to be taking action with this, then you want to be moving reasonably quickly to at least figure out what your moves are going to be, or if you are going to make moves at all. The results, if you get this right, your smart next moves become clear and you build the confidence that you need to take the action, which ultimately leads to results. This works because you're understanding the actual benefits and trade-offs of the options that are available to you. And I think the lesson here is that there's always a lot of noise out there when it comes to property. And there's a lot of things that you could be doing, but there's only one move that's best for you. Look, if this is you, if this makes sense for you, then take the time to understand your options and map out your plan. Then you put yourself in the best position possible. The next article that I was looking at was about vendors basically flooding the property market ahead of the election. We just saw the election announced last week, and last weekend just gone, we saw a flood of properties coming onto the market. There was some record, I think it was like $70 million in extra sales, like $1 billion, like 500 plus settlements over the weekend. I think there's about 30% of properties that didn't clear at auction, but it suggests that we're seeing a huge amount of properties coming onto the market. The issue is that sellers, with this amount of sellers, that the market is now getting crowded. Sellers are accepting lower prices so that they can get their deals done, particularly with the uncertainty around the election, giving them a bit of a question mark. So what that means is that it creates an opportunity for buyers, means that there's more choice out there. It's becoming more of a buyer's market. So if you want to take advantage, you need to make sure that you're making smart choices. The actions that you want to be thinking about here based on this is to do your research to really understand the market. There is no substitute for just looking at property, looking at what's selling, looking at what it's selling for, so that you know when you're looking at property what a real fair price is. And then, making sure that you've got a solid plan. And can't stress enough that it's about planning not just for today, but, there is talk of rising interest rates, like making sure that a property purchase is going to fit with how things are going to progress for you moving forward from here. The results, when you get this right, if you make smart moves, you can get a good deal, enter the market and get onto the property growth ladder. There's a lot of talk about, property market wobbles and these sorts of things coming up. But my view is that property market's still good for the longer term. And because of the gearing impact, the borrowing to invest impact of buying property, it's still one of the best, if not the best option for people that are looking to actually grow their assets and build their wealth. This works in particular because property sellers are fearful based on the uncertainty that's out there. So now is the time to be a little bit selfish, a little bit greedy, and take advantage. There's that saying, when be greedy when people are being fearful, be fearful when people are being greedy. And I think that holds very true here. I'm talking to a lot of people about property moves in particular, and they're saying, oh, there's uncertainty in interest rates. What's going to happen? I'll wait and see. But if you wait until we see what happens, then the opportunity could potentially be gone. The lesson is that the property market is always dynamic, but it's constantly in a state of serious flux. And the conditions that we're seeing now are not what we were seeing a month ago, which means that they may not be what we're seeing a month or two from now as well. So the conditions may not last for long. If property's on the roadmap for you, take the time to set up a rock solid game plan so that you can make your next moves with confidence. The next article that I was looking at was about the jobless rate, and looking at the jobless rate in New South Wales in particular, where in some areas that the jobless rate is actually as low as 1%, but in others it's as high as 9%. So for people in the higher unemployment rate suburbs, what it creates an issue around the fact that the higher unemployment rate is going to constrain property prices. And it means that potentially, especially because we're seeing rising interest rates come up, that property values are potentially more likely to decline in those suburbs, or at least the people who live in those suburbs. The opportunity, though, on the flip side, means that there's some good value potentially in those markets that are impacted by higher unemployment. It also means that for suburbs where the unemployment is lower, that we're potentially seeing property values continue to rise further. So the framework here for you to take advantage is, if you're looking at property, you want to understand the risks of those two different pathways and think through the potential impact of each of the options and understand how they fit with your broader game plan. So instead of just listening to the noise and the media hype, you're going to take the time to understand, to educate yourself about the risks and understand those risks and how they can actually be managed for you. If you get it right, you can take advantage of the opportunities that are there to build wealth and make money while that fear and uncertainty that I previously mentioned is in the market. This works because you're sticking to the fundamentals instead of just letting the emotion and psychology drive your actions. The lessons here is that the headlines are one thing, but as markets change and we adapt to this new normal, opportunities exist for people that are ready to keep a cool head and be smart about how they plan and tackle their investing. My suggestion is that for anyone that thinks that they might be in a position here to make some moves, plan fast, even if you act slow, or even if you end up planning to do nothing. So understand, what could you do? What could you do in the different options that are in front of you? And is it the right move for you? How are you going to manage your risk and put yourself in a position to decide whether taking action is the right move for you? If you decide to take action, then make it happen fast, as the market is dynamic and changing. The final article that I have for this week is on first home buyers, that is poor first home buyers, talking about the conditions worsening for them, meaning that rising rents mean that it's even harder for first home buyers to get into the market because they're in more of a cash pinch. They were talking about the fact that rental vacancy rates are now below 1%, meaning it's a landlord's market. We're also seeing rising interest rates on that, making property less affordable, or mortgages less affordable. And to top it all off, property prices have just gone up by 25%, meaning you have to pay more for the property. Now, that's a lot of negativity there, obviously, but it creates an opportunity, I think, for first home buyers in particular to look more closely at rent vesting, meaning that you can get onto the property ladder and then use higher rents to have someone else pay off your mortgage faster. Instead of putting property into the too hard basket, which is an easy thing to do, don't get me wrong, First home buyers should then take the time to really understand the difference between buying a property as an investment and buying a property as your own home. The actions here, if you think this is something you should consider, you want to run your numbers with a focus on investment property versus your own home, but at the same price point. And don't forget to factor in the tax breaks for property investors, which do make a big difference. If you're not a spreadsheet boss here, don't be afraid of getting good help, because if you're making a $500,000 or $1 million decision, making the ideal moves is going to make a big difference for you. When you get this right, you get clear on the ideal strategy for you and should set yourself up to get into the property market sooner and start getting that growth that we see on property over the long term. It works because you're controlling the controllables instead of just hands in the air, too hard basket. You're controlling what you can to take action where you can as well. And the lesson I think here is that there's a lot of different ways to be right when it comes to money, but pushing through the initial hurdle and getting yourself into the property market is going to pay you big dividends over time. If you set up the ideal strategy for yourself here, your future self, let me tell you, will definitely thank you for it. Guys, I hope you found this helpful. If you enjoyed it, I'd love to hear your feedback. Feel free to drop us a note, and I will catch you next